Here's something nobody tells you about millionaires. They don't actually spend their money, not the way you think they do. When a billionaire buys a $100 million yacht, he's not writing a check. When a tech founder purchases a third home in Aspen, she's not liquidating stock. And when you see someone driving a Bentley with a net worth of $50 million, there's a decent chance they have less cash in their bank account than you do. This isn't a story about budgeting or side hustles. This is about a mechanism, a quiet financial architecture that the wealthy use to live like they're rich without ever actually touching their wealth. And once you see how it works, you can't unsee it. Let's start with a problem. You have $10 million in Tesla stock. It's gone up 400% in 3 years. You want to buy a house, a nice one, $2 million. Obvious move, sell some stock, buy the house. But here's what happens when you do that. The moment you sell, the IRS wakes up. You're looking at long-term capital gains tax. Best case scenario, you're handing over 20% of your profit, maybe more depending on your state. On $2 million, that's $400,000 gone. Just gone. To fund a purchase you could already afford. So you don't sell. Instead, you borrow. You walk into a private bank, not Chase, not Wells Fargo, a private bank that deals with high net worth clients. You put up your $10 million in stock as collateral, and they hand you a loan for $2 million at maybe 3% interest. No taxes, no capital gains, no selling. You just borrowed your own wealth. And this is where it gets strange. This strategy has a name in wealth management circles. Some call it buy, borrow, die. Others just call it smart. But the mechanics are always the same. You buy assets that appreciate. You borrow against them when you need cash, and you never sell, ever. Because here's the trick. When you die, your heirs inherit those assets at their current value. It's called a step-up in basis. All those unrealized gains, they vanish, reset to zero. Your kids get the full 10 million or 50 million or 500 million without owing $1 in capital gains tax on the appreciation that happened during your lifetime. The loan, it gets paid off from the estate. But the tax bill you spent decades avoiding, it never comes. Let's put numbers on this. Say you bought Amazon stock in 2010 for $100,000. Today it's worth $3 million. If you sold it, you'd owe taxes on $2.9 million in gains. At 20%, that's $580,000 to the IRS. Or you borrow $1 million against it at 4% interest. That's $40,000 a year in interest. Over 10 years, you've paid $400,000 in interest, but you've avoided $480,000 in taxes. And more importantly, that $3 million is still growing, still compounding, still working for you. When you die, your kids inherit it at $3 million, no tax on the growth. They sell it if they want, or they borrow against it too. The loop continues. Now you might be thinking, okay, but I still have to pay back the loan, right? Technically, yes. Practically, not really. Because here's what the wealthy do. They don't pay back loans in the way you and I think about paying back loans. They refinance. When the first loan comes due, they take out a new loan against the appreciated value of their assets. The new loan pays off the old loan, and they pocket the difference. It's not a paycheck, it's not income. It's leverage on top of leverage, disguised as liquidity. The bank doesn't care. They have collateral, and as long as the assets keep going up, everyone's happy. But this only works if you have assets, a lot of them, and if those assets are liquid enough to borrow against, but stable enough not to collapse. Which brings us to the uncomfortable part. This isn't for people with $100,000 in a retirement account. This is for people with $10 million, minimum. And even then, you need the right kind of assets. Publicly traded stock, real estate in the right zip codes, art appraised by the right auction houses. Banks don't lend against your Robinhood portfolio. They lend against certainty. And the interest rates they offer aren't available to regular borrowers. If you tried to get a personal loan for $2 million, you'd be quoted 8%, maybe 10%. The wealthy get 2 to 4%, sometimes lower, because they don't need the money. That's the irony. The less you need a loan, the cheaper it is. The entire system is built on the assumption that you'll never actually spend down your wealth. You're just accessing it temporarily, and the assets backing your borrowing will always go up, until they don't. Let's talk about what happens when the math breaks. 2008, the financial crisis. Stock portfolios collapsed 40%, 50%, 60%. Real estate imploded, and suddenly all those loans backed by assets weren't backed by much at all. Banks issued margin calls. They demanded more collateral or immediate repayment. And the people playing this game had two choices: liquidate assets at the worst possible time, locking in catastrophic losses, or come up with cash they didn't have. Some went bankrupt. Others had to sell trophy properties, art collections, entire businesses. The strategy works beautifully in bull markets, but in a downturn, it's a trap. And here's the darker layer. When millionaires and billionaires borrow against assets instead of selling them, they're not paying income taxes. They're not paying capital gains taxes. They're paying interest to a bank, which is tax deductible. They're generating liquidity without generating taxable events. Meanwhile, someone earning $80,000 a year pays taxes on every dollar. A teacher, a nurse, an engineer. Their income is taxed before they even see it. The system isn't broken. It's working exactly as designed. It's just designed for people with assets, not income. So why don't more people know about this? Because it's not illegal. It's not even a loophole. It's just how the tax code works. Unrealized gains aren't taxed. Borrowed money isn't income. And the step-up in basis at death is written into law. Politicians talk about taxing the rich, but they're usually talking about income taxes. And the truly wealthy don't have income, not in the traditional sense. Jeff Bezos' salary at Amazon was $81,000 a year. Elon Musk takes no salary from Tesla. Their wealth is in stock, and they access that wealth the same way we've been describing. They borrow. In 2021, ProPublica obtained IRS records showing that between 2014 and 2018, the 25 richest Americans saw their wealth grow by $401 billion. They paid $13.6 billion in federal income taxes. That's an effective tax rate of 3.4%, not because they cheated, because they borrowed. Here's where it gets philosophical. Is this wrong, immoral, or just smart? You could argue it's legal tax optimization. Every high net worth individual has a fiduciary duty to minimize taxes. That's what accountants are for. That's what the system allows. Or you could argue it's a structural flaw that lets wealth compound indefinitely without ever contributing to the public services that made that wealth possible. The roads, the schools, the legal system, the military protecting global trade routes, all funded by taxes that the wealthiest are systematically avoiding. Not evading, avoiding. There's a difference, but the outcome is the same. Let's zoom out. What does this mean for the average person? If you're building wealth, the lesson is clear. Assets beat income every time. A salary of $200,000 sounds great until you realize you're paying $60,000 in taxes. But $200,000 in unrealized stock gains, you owe nothing, and you can borrow against it if you need cash. The goal isn't to make more money. The goal is to own more assets, because assets appreciate, and appreciation isn't taxed until you sell, which you never do. Here's the part that should make you uncomfortable. This strategy isn't creating value, it's extracting it. When you borrow against assets and use that borrowed money to buy more assets, you're inflating demand. You're pushing up prices. Real estate, stocks, art, anything scarce. And the more prices rise, the more you can borrow, which pushes prices higher, which lets you borrow more. It's a feedback loop. And it works until everyone's doing it, until borrowed money becomes the majority of liquidity in the market, until asset prices are untethered from fundamentals and backed only by the assumption that someone else will pay more tomorrow. We've seen this before. It doesn't end well. So here's the question. If the wealthiest people in the world are borrowing instead of earning, and asset prices are rising faster than wages, and the tax base is shrinking because unrealized gains go untaxed, what happens next? Do we change the rules? Tax unrealized gains? Close the step-up basis loophole? Or do we accept that this is the game and the only way to win is to play it? Because right now, millions of people are working for income while millionaires are living off loans. And the gap isn't just widening, it's compounding. The millionaire's secret isn't discipline, it's not even intelligence, it's leverage. And the system is designed to reward the people who already have enough to borrow against. Everyone else, you're still paying taxes.
If this kind of breakdown is useful, this is exactly what the channel does. No hype, no shortcuts, just how the system actually works. Subscribing just means you won't miss the next one.